Thank you for joining us today. For those of you who don't know, my name is Jerry Pryor, and I'm the Chief Operating Officer and Senior Portfolio for Mount Lucas Management. My responsibilities at the firm primarily involve running our managed futures strategy. I am also the lead PM for the KMLM fund. I'm happy today to be joined by our firm's Co-CIO, David Aspell, who runs our firm's global macro strategy. A couple items before we kick off today. We want this to be an interactive conversation, so please feel free to submit questions to us. If you are streaming on the KraneShares site, and send your questions to info@kraneshares.com. If you are joining via Zoom, you can submit questions via the Q&A button at the bottom of your screen. We are offering one CFP and CIMA credit for this webinar. If you wish to receive credit email, or if you wish to receive credit, email ce@kraneshares.com with your CFP and or CIMA number. So a lot going on in the world today, and we have a lot of ground to cover. We will start out today discussing the investor risk premium and managed futures, why it is interesting, when it works and when it doesn't, and use that framework to talk about recent performance. We will then transition into a deeper discussion on global macro events with David, driven by market charts in areas where those events have significant impact and KMLM has exposure to. So first, let's get started with why should we want to do managed futures in a portfolio anyway? Where does the premium come from? And how does that help me as an investor and putting my portfolio together? Hop ahead here a couple of bits. So futures trading is a little bit different than, and this may be review for some, but futures trading is a little bit different than equity trading. Futures trading has been around for, or at least on exchanges, for about 175 years in the United States. So not quite as long as equity markets, but a long time nonetheless. But futures markets exist for an entirely different reason than equity markets. Equity markets exist so businesses and companies that are looking to build and grow their companies go to investors who allocate capital to them in hopes of earning an investor risk premium associated with the future growth of those companies, future dividends, future capital appreciation. Equity markets are well understood by investors. Credit markets are also very similar. Business and companies go to credit markets to borrow money. Those are very similar investor risk premiums. It does well when the world's growing, when we have global GDP is increasing. Those are good periods for equity and credit investors. Futures markets exist for an entirely different purpose. They're a derivatives market. They exist so that those same businesses and companies who face exogenous price risk, whether it's in interest rates, FX, or commodities, exogenous price risks that they cannot control, that materially affect the operation and running of their businesses. They go to the futures markets because they're looking for price certainty in those markets so that they can run their businesses as efficiently as possible and maximize their margins to the best, and the certainty around those margins as best as possible. So that's why futures markets exist. And where do investors exist in futures? Well, we're the ones that are entering the futures markets and willing to accept price uncertainty. We're willing to take those interest rate risks, we're willing to take those FX risks, and we're willing to take those commodity risks. And what we do is provide businesses and companies with price certainty while we accept all of the price uncertainty. How does that work through time? As an investor in this space, we want to systematically accept price risk through time across many different sectors and many different markets. And ultimately, that's the investor risk premium in futures. And so what does that intuitively tell us? Well, when prices are moving around a lot, which would put businesses and companies at risk, that is when the investor risk premium in managed futures is doing the best. When markets are stressed, whether they're stressed at an individual market level, if you with a supply demand imbalance in crude oil or soybeans, or central bank policy rapidly changing, and currency movements and interest rate movements. Those are that can happen at an individual level, and managed futures will do well from that. But when managed futures does really well is when there's a lot of price dislocations going on across the economy. And when those sort of bunching events happen, they typically happen in periods like inflation that we saw in 2022, or deflation, which, 1987 or the GFC or after the tech bubble, those type of worlds. So when you start thinking about managed futures returns and why it's in the portfolio, that's the kind of investor risk premium you're getting at. You're getting at something that does well in periods of stress, where typically equities do not. But then when prices are stable and things are good, it may not make as much money, but that's what typically when stocks and credit markets are doing really, really well. So that's sort of the premium you get when you get managed futures. Hopefully that helps you understand the framework of why you own it. And when you're going through periods where managed futures isn't doing well, but stock market's up 25, it helps put that framework, it helps you set proper expectations around this investment that you do want to hold, keep in your portfolio as sort of a core asset allocation, so that when times do get stressed, you have something in your portfolio that is working for you. So a little bit of the mechanics around that, and how the index, the MLM index that we created in 1988 works, and that's the index that KMLM is replicating as a sort of a passive ETF. So we talked a little bit about what we want to do as managed futures is accept price risk through time across many markets, and across many different sectors. So how do we go about systematically accepting price risk through time? The premium we're looking to gain is if markets go way down, we want to benefit, and if markets go way up, we want to benefit. That's the same risks that the businesses and companies face. They're worried about prices going way down, or they're worried about prices going way up. What they're not worried about is prices being stable. So we're taking the opposite of that trade. The payoff premium we're looking for looks a lot like a long straddle for those of you guys that like options. If you don't like options, bear with me. It's not particularly complicated, but you've got basically a straddle gives you a long call and a long put at a strike price. You have unlimited upside if the market goes down. You have unlimited upside if the market goes up, and you lose a little bit if the market price stays around where it is between when you put it on and expiration. So one way to go about earning the futures risk premium is you could use straddles, but there's other ways to get at this same payoff premium in a much more cost efficient manner. And this is the way that managed futures managers have been doing this since the early 80s. The dominant way of capturing the managed futures return is through trend following. It's what most managers do. Trend following is simply a systematic approach that gets you this payoff premium. The way it's done in our index is, in order for trend following, we use a simple moving average, 1 year moving average. We look at the price. If the price is above the moving average, we're long. If the price falls below the moving average, it's short. If you think back to that option straddle, that payoff premium thing I just showed you, as we're moving along this chart, as we're moving up this line, this is a crude oil chart from around 2008. You have unlimited upside, and we stay long as markets are going up. And then as they start to go down, so this is your trailing stop. So that's that. Go back one. That's that middle part, right there is the strike price is your that trailing stop. Oh, sorry. And then on the short side, once we get short, we have unlimited upside on the bottom, but we always have a trailing stop to limit any losses. So what you end up getting out of that is you get something that is more often than not, if it's right around the moving average, you're getting small gains, small losses. And then occasionally you're getting a market that move like crude oil did here in 2008, where you make a really large gain and you get a sort of that fat right tail of a trade. You do this across individually across all the markets in the index, and you end up producing, and this is sort of the promise of managed futures in general, is by using a systematic approach like trend following. There's a lot of different ways to do trend following. Besides using moving averages, you can use breakouts, moving average crossovers. There's any number of approaches, but they all kind of get you the same thing, that sort of unlimited upside in that right tail. You end up producing with it, a right skewed or a positively skewed distribution. And what that means is, our tails tend to be on the right hand side. But what it also means is the majority of our trades end up below the median and below the mean. So, as an investor, it can sometimes be frustrating to own futures, because, on any given day you're underwhelmed by the performance, but then every once in a while, and every couple times a decade, 2 or 3 times a decade, it produces real meaningful diversifying returns over on the right hand side. Now, that return distribution is the exact opposite of what you get when you invest in equity and credit markets. They're the majority of observations are above the mean. You feel every good that you're on most days, you feel really good about your equity investments. You're patting yourself on the back, saying, "Good job, I'm a great investor." And then a couple times a decade, you get that big left tail. And for you got to cancel your tea times and start picking up the phone and talking to your clients. So what managed futures does when you put it in a portfolio, it sort of just merges these two distributions. Because managed futures does really well when things get really out of whack, inflation or deflationary periods, things that are sort of really harmful to your equity investments. When you put these two distributions together, you start to reduce the overall portfolio volatility. You reduce portfolio drawdown, and you end up with sort of a better portfolio, a better Sharpe ratio portfolio. As an investor. The way we approach managed futures, at least with our index, we trade global fixed income markets, developed currency markets, and commodity markets. We don't trade every futures market under the sun. We trade, because we know managed futures is here as a diversifying instrument. We want the biggest and largest markets that are sort of going to be the most react the most in stress environments, and be big and large enough to handle all of the flows that get created in sort of stressed event like 22 or GFC, something like that. So, like I said, you merge those two return distributions together. You start adding managed futures into a stock bond portfolio. It's an uncorrelated return, but tends to get really negatively correlated in periods of stress. You get this, the efficient frontier story is pretty simple. Any addition of managed futures starts to push it up into the left, which is where you want to go. Lower vol, little better return. You can see that here in the table here on the left as well. As you start to add managed futures into stock bond portfolios, portfolio risk goes down, maximum drawdowns go down. And then this is another way to look at this here. This is a market events chart, so these are all periods where the S&P 500 since 2010. So we didn't even include the GFC in here, which would have been a good period for managed futures. But since 2010, every time the stock market has gone down by more than 10%, and what managed futures has done in these periods. And we show this managed futures in two different ways here. One using our index, and also the SG Trendex, which is a another managed futures benchmark. We're a price-based benchmark, so we're, like the S&P 500. It's made up. Its performance is made up of the underlying constituents. SG Trend is a manager-based benchmark made up of the top, AUM-sized trend-following managed futures managers. So one is a manager-based index. Ours is a price-based index. There are some differences to the way our index works relative to them, but largely speaking, our results tend to rhyme, and you can see that here. Anytime we've had a lot of these big, sort of negative drawdowns in stocks, we just had one at 10.1%. I'm not sure if that that was it, or it rallied a little bit off the bottom, but we'll see how we go. We'll talk a little bit later about some macro events, but that we were about flat over that period over the last couple of weeks. Definitely an uncorrelated return. You'd like to see a positive return. There are other periods where we've gone down here and just had muted managed futures returns, but certainly uncorrelated and certainly not as susceptible to the market risks that equities and credit are facing. And this is the we call this the managed futures smile. This is what you're looking to get. Decently positive returns when uncorrelated returns when generally speaking, uncorrelated returns when equities are going up, but deeply negatively correlated when equities are going down. So that's that smile. Managed futures making money when equities are down. So these are annual returns here. It just sort of reiterating the same point, why we're putting managed futures in portfolios, particularly as it relates to the world today, in particular coming out of 2022, is the 60-40 portfolio really has benefited over the years from that sort of constant Fed put that was always in the market. Every time stocks went down, bonds went up. You had protection that existed for most investors' lifetime up until 2022, when inflation, which hadn't been a worry in a really long time, became front and center. A lot of that inflation, at least from an economist point of view, not necessarily from a price level point of view, but from an economist point of view, that some of that inflation appears to be less of a worry today, but it's still front burner in the Fed's mind. So the idea that bonds are going to protect you in the next equity drawdown or the current equity drawdown just might not be true. And today's investor needs more tools in the toolbox to invest with. And with managed futures, it offers you more tools. It offers you both sides of the return distribution. So we can be short bonds, we can be long bonds, we can be short commodities, we can be long commodities, we short the dollar, and we can be long the dollar. So the way in the GFC, managed futures gave portfolios long. They were long bonds and short commodities. In crude oil going from 150 to 30 and bond prices going up, and we were long the dollar during that point, provided enormous relief for somebody that had a diversified portfolio that included managed futures. Conversely, in 2022, where it was more of an inflation worry as opposed to a deflation worry, managed futures provided returns on the short side of bonds, which nobody else gave you in 2022, and on the long side of commodities because of the Ukraine war and grain markets and wheat and natural gas, crude oil. You got access to all the sort of flows that were going on and on the long side of the commodity return. So in 2022, when inflation was front burner, the typical inflation issue or inflation asset classes, whether it's tips or gold, were completely unhelpful. Managed futures was sort of the best performing asset class during that period of time. As we go today with big giant macro administration goals and lots of things shifting around in the macro space. It just gives you more tools and more return distributions to play with, being able to be both on the long and the short side of things, depending on sort of the way the macro direction settles out here. We talked a bit. Oh, I just went through this a little bit. I'll keep going. So what's going on in 2024? Not a great year for trend following in general. I show us here relative to the SG trend, mostly to highlight one thing. Most of the managers that are in managed futures do include equities as part of their asset allocation, where we do not. So that's probably the main distinguishing feature between our price-based index and what the managers are doing in the space. The gray area chart here is the S&P 500. You can generally see, most markets didn't trend too particularly well in 24, but equity markets did. When equity markets were going up, these managers on a relative basis were performing better than our index. Pretty much up until you had this break here in the yen carry trade, and which fed into the stock markets and bond markets, and so you saw a lot of trend reversals. Since these guys can get pretty long stocks, they're really susceptible. If there's a market pullback off of equity highs, and you saw that here. So we're just trudging along, sort of uncorrelated to what's going on in stocks, and they really felt that in this period here from sort of July through the into August, until they, for the most part, got out of their equity position. So again, we start, our performance starts to rhyme again with them pretty well, until you got this big leg up there at the end of the year in stocks again. As they started to get long stocks again and started to pick up that fluctuation, a little bit of outperformance from them. But in general, and we'll get into this more in the market charts in a bit. But in general, that's the main story going on. It was sort of a back and forth year in markets outside of equities, and the managed futures returns reflected that. So far, year to date, you saw a lot of the same things going on. Again, the big managed futures managers sort of outperforming as long as stocks were doing well. As soon as the stock market broke, that completely disappeared, and they ran to this is through as of 3/14. So so it's a little bit stale. But it's I think we're running right next to each other at this point. So we'll get into a little bit more of what's going on here, why things aren't trending recently versus where they were 18 months ago, 24 months ago. And maybe that sort of helps understand expectations around what's going on in these markets, and then at how we interact with global markets and global events and macro themes, and how that pushes through to market prices, and then how we're picking that up through time in our index in the managed future space. So I'll pause there a little bit. Stop the share for a minute. I'm gonna hand it over to David here, and he's going to go through some sort of his macro views, and we'll start running through some market charts.
Okay, thanks, Joe. I'm Dave Aspell. I'm the Co-CIO at Lucas. I run the macro strategy that allocates to trend following as well as equities and discretionary trading. And what we're going to do today is to look at the macro landscape that's currently out there and try to illustrate how the shifts we're seeing across trade policy, tariffs, sanctions, and the economy translate into the moves in relevant assets that we take positions in from both the long side and the short side. We're going to look at a few of the major benchmark markets that we trade over the past couple of years across commodities, currencies, and fixed income. we had a question about why we don't take equity positions. And generally, we find that if you're building portfolio elements for maximum diversification, like trend following is to us, and it's used in a broader portfolio that includes equities and credit. Us adding equities kind of muddies the water for diversification. Investors generally have enough equity risk already. They don't, in the diversifying asset pool, they don't really, we think, need us adding more equity length. So that's one reason why we don't do it. So we're going to look at gold, crude oil, and then wheat and commodities, and then move on to some of the biggest movers in the FX space over the past few years, which Japanese yen, and then look in detail at a couple of the fixed income markets that we take positions in, the US 10-year and the UK gilt. And we're choosing these markets because they cover both longs and shorts, some trades that do well, some trades that don't do so well, and some periods where markets are trending strongly, both up and down, and some periods where they're not really doing much of anything. And we're in that middle of the straddle, close to the strike period, where there's not much happening. One of the most useful and interesting parts of trend following to us is that it does give both sides of that return distribution. So we're going to highlight some of those. The other thing that's real interesting to us is that in a portfolio context, as well as the short exposures, it does give direct exposures to shifts in things like trade policy and relative economic cycles, and direct exposures to the places where trade policy and sanctions play out. And that's why it's real useful in a portfolio. It's these big shifts in macro markets, that volatility and uncertainty that bleeds first into equity market multiples and can push equities down as multiples compress. And then that's because as equity markets stabilize, prefer stability. The companies themselves prefer stability in big macro markets that impact their business. If you're a multinational company, uncertainty around tariffs and trade policy and immigration policy, the tax regime, things like that, it makes planning very difficult. And in times when planning gets difficult, one of the things that companies do is pull back on activity. So it first bleeds into the equity market multiple that investors are going to pay. And then if it persists and worsens, companies pull back activity, they reduce hours, reduce their employment, they delay that marginal project, they cut hiring back. And if that spreads and continues, that's how that morphs into recession. So it's not necessarily what we see right now, but generally that's how the uncertainty and instability does bleed into broader asset prices. So where do we stand right now, and what does we see as the administration goals, without getting into the politics of whether these things are good or bad, right and wrong, or even whether they'll be successful? I think that's a ways outside of our scope. This is roughly how we see it, and we're going to use gold as the first example here, which we've got on the screen. So I would say, broadly speaking, the economic plan that the administration is trying to run through has got a few North Stars guiding its way. It's a little messy in places, but broadly, I think this is a pretty fair take that the US has been running very large fiscal deficits over the past few years. They are unsustainable in the long term. That's a fairly bipartisan view. Last year, it was a little under $2 trillion, which is about 6% of GDP. That's notably bigger. That's basically a wartime crisis level of deficits that we're running in normal times. We also run a trade deficit of a little over $1 trillion. We import a little over $4 trillion and exports about $3 trillion, which leaves us $1 trillion trade deficit. And what we see in the current Trump administration is they want both of those deficits to be reduced, and they're using the tools that may, or I guess may not be available to them, given how the courts are going to decide these things. But they're using the tools that are roughly available to them to do so, but outside of the regular congressional channels, which what makes this period seem different. The US fiscal deficit is loosely summed up. Their attempt to try and rein it in, loosely summed up, at least initially and most famously, by Doge. And on the trade deficit side, it's the use of tariffs to impact trade flows. The national security side of the use of sanctions to try and force policy changes. As we see it, the issue the economy faces is that the accounting identity that has helped stocks over the past few years, post-pandemic, when government spending was so high, was that public deficits become private profits. And that also works in reverse. If you cut the deficit a lot, all else equal, it's going to be a drag on growth. And to keep the economy going, the administration is looking for changes underneath the macro aggregate to try and reduce government jobs and then try and shift to private sector or try and do other things like selling gold and green cards to raise money, those kind of things. So in the short term, that can be messy and lead to volatility. Managed future strategies are often look through that volatility and are able to capture that as it flows through markets. So the first chart we look at is directly impacted. We've got it on the screen right now, is gold. We've got a synthetic price of gold because when you're trading futures, you need to roll them because futures markets have expiry. So this is what happens if you hold a gold futures position over time in blue. This chart runs over the past few years, and we've got the moving average that we use to, as the long short signal. So the blue line shows the returns of holding it. The red line is the moving average. We use longer term measures of trends. Generally speaking, our research has shown that good trend following returns that are most helpful in a portfolio context are slower. And although it makes the element a little more volatile, it's more useful in a portfolio. So for gold itself, what's going on? Well, gold's something of an odd commodity. To some, it's a store of value. To others, it's a real rates trade. To others, it's just a currency. I mean, clearly it has jewelry and some industrial uses with their own supply and demand curves like other things. But these are rarely a large driver of price, I would say. The past 18 months or so, we've seen a good uptrend that's taken gold to record highs. We're up above $3,000. Trend following has been in that on and off for most of that period. You can see when the blue line's above the red line, we're long. So there was a period where we were long, then it was choppy for a little while. And then this most recent move of 30, 40, 50% up, depending on where you draw your lines, we've been long it. So why is it going up? What's been driving it? Well, it's hard to know for sure, particularly in real time. But one driver seems to be that central banks view it as a store of value, and they're concerned by the use of sanctions that both administrations have used and looks like are continuing to use. If you read the news about what's going on with regard to Venezuela currently, that the US is somewhat weaponizing the financial system, for want of a better phrase. And if you're a central bank in a country that may or may not be on the best terms with the US, and you want us to store money outside of the long reach of the US Treasury, gold is one of the places where you can do it. So it's a good example of how individual markets that we take positions in can give exposure to the macro shifts that are happening in the world. It doesn't seem to us like the drivers of this change are going away anytime soon, but of course, you never know. So that's it. If we move on to crude oil, that's how gold is done. We've been long it for a while. If you move on to crude oil, we should have that one on the screen now. It's the same chart as before. We've got the blue line is the rolled futures prices. The red line is the moving average. It's an interesting chart to us because you can see a great trade on the short side through the pandemic as the pandemic hit hold in early 2020. Then you see a recovery trade where the blue line's above the red line and we flipped along that runs all the way through the Russia invasion of Ukraine. And then a real long choppy period that trend following really struggles with. If you see what's happening over the second half of that chart, crude oil goes up a bit, so we move to a long position, and then it goes back down. So we lose a little bit of money on the long, and we get short, then it goes up, and then it goes down, and the constant moving back and forth between the blue line above the moving average and below it is where trend following takes small losses.
Yeah, just to interrupt there a little bit. I mean, this sort of feeds back into the investor risk premium here, right? You got being short crude oil during the pandemic was an enormous add, to the portfolio. I mean, it was a huge move. It's a huge beta move. You got a lot of protection from equities by being short crude oil at the beginning of the pandemic. Again, it's more tools in the toolbox. And then as you head in the Ukraine war, you're long oil and you follow it all the way up. It's giving you protection. These are real things affecting real prices that are harmful to your equity portfolio. That managed futures has the ability, has exposure to, and the ability to be both on the long and the short side of it. Now, things aren't always trending, and sometimes they're not, and prices are stable. And you enter a long period over the last 18 months, 2 years here in crude oil, the second half of that chart. Ultimately, the way we trend followers look at this is, this is a lot of lost a little on the way up, lost a little on the way down, lost a little, make a little, lose a little. This is the cost of owning trend, right? Is during these stable price periods, and you have to sit through them so that you have the exposure on when you do get the big moves like we saw in the pandemic and in the Ukraine war. So to us, this is how trend following works. You make a lot on a trade on the way down, you make a lot on a trade on the way up, and then there's the cost when it's just bouncing around the moving average. So that in ultimately that's what produces that positively skewed distribution and protection during periods of stress. This last period has been a great period for stocks and crude oil, and not surprisingly, stocks don't mind when crude oil prices are pretty stable.
Yeah, that's exactly right. So yeah, why do we, if you use the crude oil chart again, if you look at why is it that we get that huge drop in the pandemic? You think, well, one interesting thing about commodities is that they have to exist in the here and now, and those markets do have to clear, which is different than equity markets and bond markets. That equity markets generally can look through the near term of a bad quarter or two, as the value comes from a much longer term stream of expected cash flows over the next 20 years with a terminal value at the end that gets discounted back to the present. But commodity futures get delivered to a particular time and place. Right now we're sitting in March. We've just rolled out of the March contract. And now we're in the June contract because it has to clear, and that's what the markets are for. They're not for us to trade in; they're for companies to secure buys and sells. So because they trade to that time and place, it has to clear. And this is how, in I think April 2020 it was, crude oil futures can trade negative. If you back up and set that scene, the reason why it happens, the world produces and consumes a little over 100 million barrels of oil every day and is balanced at those levels. And in that period, you get the right-hand side of the chart where if you're in balance, you don't really move around a ton. But if demand increases a lot, we see prices rise, incentivizes more marginal supply. But the same thing happens in reverse. In the early days of that pandemic, a lot of travel was stopped. People stopped driving to work. You couldn't fly to Europe. International travel stopped. Work travel stopped. That's a big demand drop off. So what happens to price? Well, it takes a little while for supply to respond to those drops in demand. At first, you put it in storage, you run it more slowly through pipes, you fill up tankers. But at some point, you just ran out of places to put it. And when that happens, it can trade negative. And it's just a great example of that straddle type of payoff. As we move through the pandemic, the next part, we get vaccines, prices in crude oil recovers as demand picks up, but it takes a while for that supply to come back online, as it takes some higher prices to make it economic to start drilling and pumping oil. So we can see that steady trend to the upside. It runs right through into the Russia invasion and oil sanctions, where you removed about 6 million barrels a day of Russian crude from the global market. We see upward price spikes until supply comes back. This time it came back through the Biden administration releasing from the SPR, the Strategic Petroleum Reserve. So yeah, it's a great example. The short side where it can really help you, the long side where it really helps you. And these are in periods when equity market multiples were really struggling. The pandemic sucked for stocks, and then the Russia invasion through 2022 and that inflationary period was bad for the multiples. Trend following helped out. We also see some interesting things in natural gas on the next slide, where it's an interesting chart. The period of time that really sticks out is that Russia invasion again, as Europe was dependent upon natural gas from Russia, prices spiked, long positions did real well. But then once Europe scrambled to get gas from other sources, which was helped by high prices and technology, incentivizing shipping liquefied natural gas from the US, prices fell back for a number of years. In the past 2 or 3 years, we've been largely short and doing well through that short period. So the long side did well and the short side did well. Now, although it's a little hard to see on the chart, if you were to zoom in, the past couple of months have been real fascinating to watch on the macro side. And again, what you're seeing is changes in a big macro shift in how the world works is playing out in markets. Natural gas used to be a purely domestic market, where US gas was different than European natural gas, different than UK natural gas. It wasn't a global market like gold and copper because those markets are very storable and you can put them on a boat easily. Same with oil. Gas, you couldn't do that. Whereas now you have liquefaction technology and an infrastructure being built, and markets are working to incentivize that shift. So because prices in Europe are 5 to 10 times higher than it is in the US, that level of price spread incentivizes investments in liquefaction. So we're going to start shipping it from the US to Europe. That's one thing that the US administration is going to continue doing. So over the next few years, we'll see a jump in natural gas for export and prices determined on a more global scale rather than purely local. The next one we have is an agricultural market with wheat. Really interesting one. Your eyes drawn to the big Ukraine spike again. This is a great place where having different risk exposures can really help. Wheat in Ukraine was arguably the single central commodity that was impacted, maybe oil and natural gas as well. But wheat is one of the Ukraine was one of the world's top wheat exporters. Puts out about, or did put out about 10% of global wheat exports, about 20 million tons. One of the larger exporters globally. And if you remove the ability of farmers there to grow wheat, and the ports in Odessa are shut because they can't get it out of the Black Sea, then that's why prices move upwards quickly. That's a lot of wheat to lose from the global market. We don't show it here, but there's some echo moves happen in soybeans and corn as they compete for acres with wheat in the US. If you're a farmer, you can choose what to grow. And if wheat prices are really high, maybe it's more profitable to flip those soybean fields to wheat fields, which then reduces soybean supply. So you're seeing these macro moves play out. And what Managed Futures does is give you the ability to participate in those at a time when interesting things are going on and your rest of your portfolio is getting hurt by other stuff. Luckily, you can see the second half of the chart. Wheat is something of a weed. It grows real easy. And a few harvests replenish supply. That removes the fear of it, so it starts to fall back down again. We're going to move on to some shifting gears, moving to some currencies. But we have, the next chart here shows Japanese yen. This is one of the great trend following trades that I think I've experienced. This is a really large, 50% or so downward move in the value of the yen over the past 5 years. If you think what drives dollar yen, well, it's relative interest rates is one of the drivers. There's trade flows as well, but you go through long periods where relative interest rate differentials between the two places are the driver. So inflation in the US caused US interest rates across the yield curve to go up. There was a time in 2022 when the Fed was raising rates at 75 basis points a meeting as they're playing catch up, whilst the Bank of Japan was trying to keep their 10-year yield at 10 basis points. And I think there was also a period where even Europe was hiking rates real fast. So if you zoom out and think why and how trend following these markets is useful in the portfolio, again, I've said it before, but what was it that hurt stock and bond markets in 2022? Well, it was rising inflation and then the concomitant rising interest rates. And many portfolios are built using long bonds as a diversifier to equity and credit markets, because for 40 years you had no inflation. So as soon as the economy got into trouble, the Fed would come in and cut rates, which gave a 60-40, a phenomenal Sharpe ratio. The Achilles heel of that portfolio, though, is rising inflation. That hurts bond prices as well, particularly if you're starting from ultra low pandemic level 10-year yields in the US of 50 basis points. It doesn't take much to see that bonds are going to fall a lot in that world. That's one of the it's one of the beauties of trend following. We'll get onto that in a second with bonds, but regular portfolios are dominated by long only exposures. Being able to take shorts is really useful. So where are we right now?
Yeah,
well, we're right back.
I think one thing to point out here in this one is the benefit of having a long-term moving average here, or a lengthy look back. Again, this is the red line being a 1-year moving average, which is similar, which is exactly what the index uses to determine whether it's long or short. Something that was like a 3-month moving average would be moving through this blue line and getting whipsawed out more often. So one thing we always say about using a longer term look back is, you're late to get in and you're late to get out, and you hope to earn the fat middle. With a shorter term moving average, you're quicker to get in, quicker to get out, but you get chopped up more along the way. And getting chopped up, at least in the way our research has shown, is that that chopping up period, the more chopped up you get, outweighs the benefit of the being in a trend a few days earlier, a few weeks earlier, and getting out a few days or a few weeks earlier. The chop is just too much to overcome through time. In particular, this is a fantastic trade on the yen. You saw a couple times where this thing rallied back up to the moving average and then turned around and fell back down. You got to remember those rallies back up the moving average are painful. They hurt at the time. You feel like you're on the wrong side of the trade. But this is why we do we do this systematically. We're able to hold on to that short position even when during those painful times in the trade occur. This last little period here with yen, in the context of the entire chart is not a big move, but you do feel that last little run up here in the end. And it does hurt performance in the near term.
Yeah, thanks, Jerry. Yeah, we've got a couple of questions coming actually that are maybe a good juncture to take them. Yeah, one from Brandon. Thank you. It says, does the 1 year moving average mean 365 days? We do it as trading days over the course of the year. It really doesn't, which is 252. It doesn't really matter in the grand scheme of things. As longer term is better. But what we wouldn't want is to run a model where, I don't know, like 222 days was amazing, but 224 days was terrible. That's generally not what we're trying to do. We're trying to just get a broad exposure to a robust risk premium. But that's what we're doing, a 1 year moving average. We do it as the last 252 trading days. That's how many there are in a year. So yeah, if we move on to the last two slides, we've got share exposures in the bond market. Everyone knows what's happened to bonds over the past few years. The Fed raised from roughly 0 to a touch over 5. They've knocked 100 basis points off that recently. But we're going to look first in the US and then in the UK. We trade the 10-year point on the curve. These go some way to highlight how the inflationary period we just went through has the ability where short exposures can be valuable. If you just think about like where else can you get direct exposure to rising yields? This is it's not that often you see portfolios generally are long only. Getting short exposure is real useful. So the good thing again here, you can see over 2022 particularly, it was great. We're right back at the moving average now. This means we're in a world where if we do get tariffs that leads to more inflation, it's not our base case, particularly as you'd hope that tariffs are a change in the price level rather than inflation, which is sort of technically more a process and would need to continue year after year. But you'd hope that the Fed would look through changes in price levels, particularly if there's a negative growth shock that comes with it. But if inflation is more durable for whatever reason, maybe it's the US manufacturing renaissance, maybe it's a weakening dollar, maybe it's driven by worker shortages. I don't know. It could be that the stimulus we see out of Europe, or at least seems to be coming from Europe, is real helpful and leads to a boom in global growth. I don't know. But if we do see a rise in inflation, we'll increase the short and move back to short and get exposure to the short side. And we'll make money rising yields. But if on the other side, Trump is able to fulfill one of the other large campaign promises he has, which was to reduce inflation and do it rapidly and get the Fed to be able to cut rates either to neutral or below to unclog the housing market. We're poised right now to be able to take advantage of that as well. It won't take much for us to flip into long positions. And then if we were to move into a world where the economy slowed a lot, as has been the case in previous crises, and if inflation is not a concern and you cut rates from where they are now, you've cut them 100, but if you cut them back to, or even I think neutral is around 2.8, 2.9, if you were to cut them underneath that because we cyclically slowed, then long positions in bonds could be really, really useful. Which I think is, it would be we're just as happy long bonds as we are short bonds. It just means over the past couple of years we've been short. The other one, just to finish up on these slides, you see the same thing in the UK. I only include this one as a little bit of diversification. It's a slightly different pattern. Inflation in the UK has been stickier in the UK, and the public finances are generally worse relative to the pace of growth than they are in the US. And the big spike down in 2022 was we had a Liz Truss related freak out in September 2022 that moved prices a lot. But overall, short side has been fine over the middle period. It's been a bit choppy ever since. We're currently short, but it's been a bit messy over that past couple of years. There's been a couple of spikes around Silicon Valley Bank where yields moved a lot. But if we would expect inflation to continue to reduce steadily there in the UK, and if that is the case, then we'll likely move long and move back to the long side in due course. But with that, that's the end of the market charts we have. I'll move back on to Jerry. It might be worth adding, we've got a really good question here, the one we get a lot, which is, I'll pass this for you, Jerry, is, given the dynamic exposures across commodities, currencies, and fixed income, how do you think it's best to incorporate the ETF and trend following into the overall portfolio allocation? What kind of weight and how do you view it?
Yeah, I mean, we do get that question a lot. I think for one, I think this is an investment that has to be sort of a core part of your asset allocation, right? So whatever percentage you get it. It's not necessarily meant to be traded in and out of. Like, I think things are going to get messy. Maybe I should get some KMLM, or things are really stable. Maybe I don't need it, because when we see those sort of shifts in markets, and when you need that risk mitigation, and when managed futures is providing that risk mitigation, it's really hard to predict. And you risk missing it, or missing a bulk of that risk mitigation. So the best way we see it implemented, the way we implement it in our global macro portfolio and personal portfolios, and is having a core asset allocation to it. Whether that's you need enough to make a meaningful impact to your stock and bond portfolios. It does trade at a similar volatility to equity markets, so that sort of helps along with the sizing of it. So whether it's a 5 or a 10% number, we think have a target in mind. And I think what managed futures is, it really sets it apart a lot from the rest of the alts world, is that this is a liquid investment. The ETF is liquid, but the underlying instruments are extraordinarily liquid. We could do hundreds of millions in dollars in trading, no problem, and in this ETF, and the underlying instruments, even in a period of stress, are perfectly fine to. There's plenty of liquidity. These are big, giant markets: U.S. bonds, yen, euro, gold. I mean, crude oil. These are big, giant markets. So you never have to worry about the underlying constituents having stale prices, like you might get in a bank loan ETF or something like that. So it has enormous liquidity, and what that means is, if it's giving you sort of that risk mitigating, that diversifying return in a period of stress, you have the ability to rebalance. And that's why we say make it a core part of your asset allocation, that you're rebalancing back to your target. So if you get into 2022 and your stocks and bonds are down and we're up, you should be rebalancing either regularly, semi-annually. Quarterly is probably fine, or using sort of target thresholds around your target allocation. So take advantage of that liquidity, monetize that diversification, pour it back into your asset allocation. And in order to do that, you have to think of this investment as part of your core allocation.
Yeah, that's totally right. The other question we've got here, it's a great way of putting it, actually. I like that. I'm going to steal that. It says comparing price and moving average on the chart, so positions binary at the crossovers, 100% long to 100% short, or is it more like a dimmer switch? That's a great way to put it. Yeah, it's a dimmer switch. I really like that analogy. It takes us a while to shift. That stops or mediates some amount of whipsawing that we do. So we trade it over the course of 21 days. But yeah, it's a dimmer switch of moving, and you can see that in the chart of the GFC, the positioning changes, where they go from full green to full red via some light greens and some yellows and oranges. That's the lights being dimmed. Yeah, that's totally right.
Yeah, I'll pull that up. It's a good chart.
Yeah. And then the other one we've got is, where can we get the index history going back to 1988? Yeah, that's a great question, Joe, because we do run the index in it, and we've been doing it a real long time. We've got a breadth of data, and just email us and we'll send it to you. It's available on Bloomberg as well if you have access to a Bloomberg. But otherwise, if you hit the website, email us, and we'll send the index on over. We also got a blog that details. I find generally people want the index. What they want to do is have a look at the character of returns and then try and build portfolios with it. On a blog that we have, blog.mtlucas.com, there's a couple of posts on there where we incorporate the index into some popular asset allocation models, so you can see the impact in different periods over time. And those are pretty good posts, I think. So well worth a read. So we've kind of done the work of adding it to portfolios for you in there. Okay, I think we've covered all of the questions we've got that we had come in. Thanks very much for for taking the time to to listen and to learn. And as you can see, we love talking about markets. We like talking about managed futures. If you guys have got any other questions, feel free to drop me and Jerry an email. I think their emails are on the website, and we can get back to you. But other than that, Jerry, got any concluding comments?
I don't. I was excited. I was excited for this webinar, and to kind of get look at a detailed look. I thought showing the macro world and how it flows into managed futures through sort of a chart book was an interesting take. I think it went pretty well. So thanks everybody for joining. Appreciate your time, and again, yeah, reach out with any questions.